Arun is saying, hi Dean, for particular strikes, say Bank Nifty 47,000 call 130 and put 200. Why is this happening? What information we can get it from here? Is it happening when more sellers are there or short covering? How to react to this situation? No, it is not happening because of that. You need to understand is that human psychology works differently. All right. Now, 47,000, it is the at the money strike. All right. Now, you will find that calls and puts, right? Puts are always costlier, calls are always cheaper, right? Why is this? Because the fear of fall is much greater than the joy of a rise in the markets, right? So if the market goes higher, let's say right now it is going higher, that is nothing compared to what happens when the market falls. All right. So let's say market goes higher 1,000 points. It is not as fearful as if the market falls 1,000 points. Also, this takes a lot of time. This happens much quicker. All right. So market falls much quicker compared to markets rising. So let's say someone is selling a put option. Okay. Right now, 47,000, someone is selling a put option at the money. He will try to price in more protection. All right, as compared to someone who's selling 47,000 call. Already we are overextended. People might believe that, okay, it is likely to expire below 47,000. So we can sell that. Market is going to fall intraday, this and that. So they will find it easier to sell a call than to sell a put. So they will factor in more protection. And that is why there is a difference between the premiums. Yes, it will be same even if it is trading at 47,000, because obviously people are more afraid of downside than they are happy about upside. So they will always price puts a little higher compared to calls. Make sense? So it will always be like that. Also, you might have studied the VIX indicator, volatility index, and what people say is that if the market is going up, the volatility goes down. If the market goes down, volatility goes up. But that is absolutely not true. Whenever there is a very sharp range expansion, right? Now, what do I mean by that? Let's say market is doing this and suddenly it does this in a very short period of time. The VIX indicator is going to go up. It will not go down. All right. You need to understand it will always go up. Why? Because the range expansion is there, volatility increases. All right. Whenever the volatility increases, again, the fear of this is much greater than the happiness that is, or the joy or the complacency that is there in this. All right. So smart traders will always price in puts higher than calls. And that is why you are seeing that discrepancy. It will always be there. All right. The amount might change. If the volatility is very high, the difference will also be high. If the volatility is low, then the difference might be lower. So right now, since the volatility is very high, you will see there is a big difference. Like you said, 130, 270 rupees difference. But let's say you are in something like this kind of a situation, then this might be 130 and 150, something like that. So difference might be very minimal. But right now the volatility is very high. So you are getting that 130 and 200. Okay. It does not give you any idea about where the market is likely to go and all. Don't get into that. That will again, take you in a very weird direction. Uh, just trust the fact that people are more afraid of falls than they are happier about rallies. So it will be like that. Yeah, sometimes it will be same. See, if market is very sideways, nothing is happening, volatility is low, then what happens? Both call and put sellers, they are using straddles, all right? They are trying to sell that. So what happens is that their selling will bring both the premiums closer to each other. But right now, even if they are selling straddle, they know that market is likely to fall. And also the market is very extended right now. At least that is what you can see on the charts. So they will say that, okay, I am happy to sell this at 130, but I'm not going to sell this at 130. I want higher premium because then if the market falls, I will have bigger cushion. All right. So that is why they will do it like that. And also imagine like you are a option buyer, right? So you also believe that puts are the best way to go because market is overextended, it might likely fall. So let's say you bought 200 rupee, put here at 47,000. And if the market does not go below 46,800, even if it tanks and then recovers, this is going to get destroyed. So this is also another way of trapping option buyers, right? Now, who believe that there will be a big bang trade on expiry, and then nothing happens. Why? Because they have already priced it sufficiently higher. So that is how they will play things. Arun is saying so option premium includes fear factor as well, apart from intrinsic and extrinsic value. See, sometimes things can get a little complicated, but if you really have the willingness to dive deep, I'm always there to help, right? And I like that also. So let us discuss this. Let's say market is sitting at 47,000 and 47,100 call. All right. Let's say it is trading at 80 rupees, and let's say it is trading at 120 rupees. Okay. This both are time values. There is no intrinsic value in this. Okay. Now, intrinsic value anyways does not matter. Why? Because it is correlated with market movement, right? So if you are looking at intrinsic value, the delta is always 1. What do I mean by that? So now you're looking at 46,900 call. What will be the price of this? Okay, it will be, let's say, 150. Why? Because you have 100 rupees intrinsic value, 50 rupees time value, and the market is sitting at 47,000 value. Now, if market goes 47,050, 50 points higher, now this call will be trading somewhere around to 210 rupees, something like that. Now, here the intrinsic value is 150. The time value is 60. Make sense? So what happened? Market moved 50 points. How much did the intrinsic value increase by? 50 points. So what does that mean? Delta is equal to 1. But now we all know that at the money delta is 0.5, little in the money delta is, let's say, 0.6, little out of the money delta is 0.4, and at the money is 0.5. So if intrinsic value delta is 1, how come the option has a delta of just 0.6? It is because of time value. Make sense? Now, you understand that. Now, what I'm saying is, I am not worried about intrinsic value because it moves with the market. If market does not move, intrinsic value will not move. It has a delta of 1. What we are interested in is the extrinsic value, or in other words, time value, right? Now, this time value is controlled by many factors. One is days to expiry, then distance from current market price, like at the money or in the money or out of the money, how far out of the money, all those kinds of things. All right. Then volatility in the markets, right? So if the market is very, very volatile, so market is very volatile, the volatility is very high, all right, the time value will be higher. The closer it is to the current market price, time value will be higher. So at current market price, the time value will be highest. Out of the money strikes, time value will drop. In the money strikes, time value will drop. Days to expiry. Higher the days to expiry, it is the first day of the series, time value will be highest. It is the last day of the series, time value will be lowest. All right. Distance from current market price, again, we will ignore that because it does not help us. Okay. Now what remains? Days to expiry. Because distance to the current market price again depends on the market. So market moves up and down, distance will change. So again, that factor, right, is not important. Days to expiry and volatility are the two factors that are most important. Days to expiry, in other words, we call it theta. Volatility, we call it vega, right? So this contributes to the option price. And the value for theta and vega is exactly same. Make sense? So how come? Let's say the days to expiry is 20. and volatility has some value. Okay. Now the days to expiry falls. I mean, the time passes. Now the days to expiry is only 10. But in the meanwhile, the market is very, very volatile. So the Vega has increased in equivalent amount. Okay. So let's say the time value was 50 when days to expiry was 20. Now days to expiry is 10. Ideally, the time value should have dropped considerably, but it is still 50. So what does this tell you? That even though 10 days have passed, the time value has not reduced. So why it has not reduced? Because the volatility has increased. Make sense? So what does increase in volatility means? Fear has increased because the market has moved extremely in a very short period of time. So if you look at the current market was in a consolidation. Now it has rallied sharply away from that consolidation. This was the accepted price value area. Now we are trading here. Traders are afraid it might snap back. They are unsure how much higher it is going to go. So uncertainty and fear has increased the volatility. How do you identify increase in volatility? Is by observing the time value or extrinsic value. Make sense? So many people ask me, Dean, why don't you track VIX? Say, I don't need this. Why? Because let's say if I am observing just one instrument, let's say Bank Nifty, if I'm trading just options in Bank Nifty, okay, then I know that, okay, if it is expiry and Bank Nifty, at the money strike price premium should be, let's say, 75 rupees at the start of the day. This is just my observation, all right? And this is not actual observation. I'm just giving you an example. So my observation over the years or months is that if it is expiry for Bank Nifty for that particular week at the money, let's say call premium should be 75. At the money put premium should be, let's say, 90, something like that. Okay. Now, if I come to the charts and I see at the money premium is trading at 180, at the money call premium is trading at 130. So what do I see? Based on my observations, this is very costly. Why is it costly? Time to expiry is always reducing. Then why these premiums are so costly? Because the volatility is higher. If the time value is reducing, why has the premium increased? It is because of the volatility. Okay. Now I'll give you one more interesting fact. You see the market like this. There is no volatility. Okay. Usually the premium at the money call should be 75. Put should be, let's say, 90 rupees, just for example. But you see there is no volatility. Still this 75 is trading at 120 and still this 90 is trading at 160. Now you are wondering, Dean said if volatility increases, the premiums will be higher. But there is no volatility. The market is in a range. Why are the premiums higher? You will encounter this situation. And you will encounter this specifically when you are anticipating a big news event. Let's say general elections 24 results. You are expecting the results. You don't know what it is. Maybe the exit polls are not very clear. Whatever is the reason. Now there is uncertainty. Despite market being in the range, the premiums will be higher. Why? Because the sellers of the option are pricing the risk of the results of this election, whether it is favorable, unfavorable. If it is favorable, market is going to go much higher. So if they are selling calls, they need extra protection. If it is going to be unfavorable, market is going to fall sharply. So they need extra protection. And that extra protection is priced in the way of increasing premiums. And that will increase what? Implied volatility. So again, there is historical volatility and there is implied volatility. So if the premiums are trading higher than usual, the implied volatilities are higher. And if the implied volatility is higher, it tells you that a big move is likely to happen very, very soon. If it is going to fall, they are pricing in fear. Even if it is going to go up, And if they are selling this option, they are going to lose money. So this fear of big move coming in is what will make them price the options higher. And in other case, when the historical volatility, like if the market has moved over the last 3 days, it comes under historical volatility. So historical volatility, if it increases sharply, that also will result in increasing premium, because now they know that if market has moved in one direction sharply, it has a possibility of coming back too. So they will again price the options higher. And always put premiums are likely to be higher than call premiums. Make sense? So all this is kind of interrelated. It's a nice mesh of complexity, non-linearity, and if you are really interested, we can keep discussing this, you know, forever, because I absolutely love it and I have done tremendous amount of work in it. But then after doing all this, after understanding all this, after spending, you know, hours and hours on all this, my conclusions that I have come to, like, it is better to trade credit spread than any other strategy, still holds, because I have gone through all this. I have tried to understand all this. I've tried to understand trader behavior and everything, and that has given me the same opinion that you don't need all these complicated, mathematics or strategies to make money in the markets. If you keep it simple, you're more likely to make money than if you try to make it very, very complicated.